Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 78 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, 78's important to you and I. Why is that?
Oh,
yeah.
Because we're 44 years old.
I don't know how old I am. I know what year I was born.
Both of us were born in 1978. How about that? Children of the 80s, though, I like to think, as opposed to like late 70s, right? Because you always go by, what strikes you, what stays with you is stuff that happens as a child. And for the most part, 1980 to 1990 is how I think of, my childhood.
No, well said. I mean, it's, I like to say I'm a Gen Xer. We're just kind of quietly doing our thing. Let the boomers, let the millennials all argue. We're just out there just trying to create some difference in the world and have a little fun along the way, which is the next thing we're going to talk about here. Episode 78 of Carson's Facts versus Feelings. We're joined with Neil Dutta talking about the economy, the amazing economy, the strength we continue to see out there. Neil is a three-time I would say I'll just say repeat offender. Three-time repeat offender on the podcast. We're huge fans of Neil. What's one of your favorite things about Neil?
I mean, the easy one to say is he gets it right. No, I think he has I think he looks at, what really matters. He doesn't follow what I like to call indicator macro. Mm-hmm. It doesn't follow like, oh, M2 did this and the S&P 500 did that, or yield curve did this and the economy went into a recession. No, he doesn't look. He looks at, okay, what really matters? What's the underlying mechanics of the economy? Whether it's consumer spending, capex, productivity, and inventory cycle, all of that, right? So all these things, bring it together, and then telling a story, nice and simply. He has a narrative too. It's not just data, and you need a narrative. I think that's the way I would put it.
Totally agree. I mean, obviously Neil's at RenMac. We're huge fans of RenMac, and what's neat about them is they're their own company, right? They can say what they want to say. And I brought this up to Neil, coming up here soon, but we've got a technical guy, Jeff DeGraff. He's amazing. If Jeff DeGraff's technical views are one way and Neil's are honestly the other, they will just go out and say it. Like they're not trying to hide it. Honestly, on our team, we have different views. Well, I wouldn't come out on TV and say one thing, and Sonu goes out to the media and says another. That's just not. We just wouldn't do it. Maybe we might disagree on something here and there.
I mean, we still have to put it in the portfolio at the end of the day. So
still got to go portfolio, and a team has to vote on it, and that's how we do it. But RenMac, I'm not saying they don't do it that way to a degree, but still, hey, if the technicals say one thing and what Neil's saying is another, they just come out and say it, and it's like make your own decision. So I'm a big fan. I'm a big fan of that. So with all of that, without further ado, here up comes 45 minutes with Neil Dutta of RenMac starting right now. There's Neil. Right. How we doing, man?
Hi, guys. How are you?
Neil, we've been doing this all day. so we're just going to sit back and let you talk a lot, if that's okay. We both just had burgers. I mean, someone kindly.
I took my jacket off. Hopefully you don't mind. I mean,
you guys might fall asleep listening to me talk.
No. But I want to start again. Let's make this very clear. I mean, we are huge fans of RenMac. Obviously, huge fans of you. We don't pay for a lot of research. Honestly, people give us research. We pay for your research. We think it is that good. We're so honored that you joined us again. But before we go there, where I'm going to start. Talk about the Disney cruise. Was there a recession on that Disney cruise last week, Neil?
No, there was definitely still a lot of supply chain problems on that Disney cruise. Let me tell you. I mean, the line to go see Mickey was, it's just, I don't know. I mean, to me, it takes a special kind of individual to actually want to go cruising. No judgment. It was pretty overwhelming. And I would say, for me, the kids liked it. I wouldn't say they loved it, and given the price point, they absolutely need to love it. So I think we're going to be going to the parks next time. I mean, that's kind of why we did it, guys, is just sort of to give them a little taste of the Disney experience. And now, I think next year we'll probably go to Orlando.
How old are your kids?
My oldest is 7. He'll be 8 in May. And I have twins, boy, girl. They're 5.
Oh, wow. Okay. Yeah. I have twins too, but they're both 7. We haven't done Disney yet. We did Disneyland, I think, the one in California.
Yeah, that seems to be. I mean, that one is probably. I feel like that one's a little bit more contained.
Yes.
But yeah, the Disney cruise is just. It's a very interesting experience.
Were there any bears there?
No, I did run into somebody that recognized me from, believe it or not, the Compound podcast, Ryan. So,
wow.
Yeah, think about that. So that was
that was that's a lot of feedback on that one, which have been positive for me when I was on last week, and you did an awesome job on there a few weeks ago. But Neil, let's just dive in. I mean, we're gonna go. Let's see here. About 42 minutes. The PCE report obviously came out this morning. Sonu and I have not had a lot of time to look into it because we've been doing this all day.
Just real quick, titles. I know we're supposed to do that beginning of every, before you get into trouble.
That's true. Chief Market Strategist, Ryan Detrick. Thank you, Sonu.
Vice President, Global Macro Strategist at Carson Group. And Neil.
Head of Economics at Renaissance Macro Research.
Perfect.
Sorry. Beyond that.
Yeah, we don't want to get in trouble. PCE this morning, Neil. What'd you think?
Well, I know you're a markets guy, Ryan, and you saw what happened with the bond market after the number came out, right? Fixed income rallied. So I think what that basically tells you is that, the markets were kind of primed for, even the upside of the upside, and that wasn't realized. And so the fact that the number came in right on the nose, you had a bit of a relief rally in the markets. And so I think that's where we are. I think what's important is that, yes, January represents a temporary setback, but what's the underlying story around inflation? My view is that inflation is still kind of on a glide path lower. There were some idiosyncratic factors that kind of drove up core inflation in particular in January. It remains to be seen whether that will be repeated. But I think whenever you have a data point doing something like this, it's always wise to just kind of go back to first principles, right? And so are households telling us that their inflation expectations are surging? No, they're not. In fact, that's continuing to improve. Household inflation expectations in the short run are normalizing. What about the labor markets? Are the labor markets reheating? There's not much evidence of that either. I mean, if you look at the employment cost index as an example, that's running at about 3.5%. We know the quits rate is down. We know productivity is up. So if compensation growth is running 3.5% and productivity is running about 1.5 to 2, then you're talking about basically an inflation number that's in line with the Fed's objective. So these numbers bob around for reasons sometimes, it's never a straight line. Markets don't correct by going sideways. I mean, that's not how it works. But I think, by the spring, we might be looking back on this January month of inflation and say, well, that was probably a head fake.
What's your story of the economy right now?
My story of the economy is things are fine. I mean, I think that's good. I think there is. I mean, to me, I would say the consensus is starting to come around a little bit to the idea that growth is better. So you see that in things like the blue chip estimates, consensus estimates. Bloomberg News has their consensus estimate. Those numbers are coming up, but I still continue to think that people are just kind of anchoring to the same sort of views here. Where as an example, we have GDP nowcasts, right? They're coming in 3%-ish. And so naturally, everyone's marking to market their near-term forecast. But there's still this expectation that things will slow down precipitously in the second quarter. And we've seen that repeatedly over the last year and a half, right? Where growth is fine right now, but is it going to stay that way? And so there's this sort of, so people are continuing to put a lot of currency behind this long and variable lag story. And I don't think the lags are nonlinear. There's this view that, the economy can deal with it for a while, and then all of a sudden it stops dealing with it. I mean, that's not really how it works in practice. I mean, and in many cases, the lags have shortened quite a bit because of the way the Fed communicates. I mean, think about it. The Fed broke the U.S. housing market without even hiking. They did that in 2022. So there's that. And of course, the financial markets, if you look at the financial markets, I mean, most of the shock has already been absorbed. I think the consensus is still anchoring to long and variable lags. And my sense is that, people are going to be flat-footed into the second quarter as well, because it's unlikely that growth will slow as much as people are saying, particularly at a time when we're seeing cyclical areas of the economy begin to light up. I mean, you guys know this. I mean, for the longest time, ISM, like, let's run our entire asset allocation process off the ISM. And now that thing is about to go above 50. If not this month, probably pretty soon. I mean, new orders are already there. So now what? I mean, I think it's kind of curious that a lot of the people that have been screaming about ISM for the last year, all of a sudden have kind of, oh, well, no, maybe things are picking up. I mean, if that's the indicator that you needed to kind of understand that, I mean, I think you're using the wrong framework, frankly. I mean, to me, it was obvious 6 months ago. We were just bleeding inventories too much, given the growth in consumption. And so it was inevitable that manufacturing was going to pick up.
So just so people know this, in case you didn't, Neil was one of the very few economists this time a year ago that was saying, listen, there's probably not going to be a recession. You pointed out some of the positive. Jeff DeGraff did amazing technical work, talked about potentially a bull market, and obviously those things played out very, very nicely. And I'm with you on the real world things. I joked before trying to buy Taylor Swift tickets late in 22 for my daughter. Just right now, my daughter wants to go see Olivia Rodrigo, pretty popular singer. Her tickets are like $600. Like Olivia Rodrigo. I mean, it's like we're not in a recession when people are spending $600 to go see Olivia Rodrigo. I mean, that's the real world stuff, right, Neil? We can talk M2, we can talk yield curve, we can talk ISMs, but it's the real world stuff. Go to a steakhouse, they're all packed. It's like there's no recession. Are we onto something there?
Well, I mean, I like looking at the anecdotes, but I mean, I tend to follow the data. So in my case, I mean, my wife and I are going to the Craig David concert in New York. That's in May. If you don't remember, I mean, but we're like geriatric millennials, right? So Craig David was like, I mean, that's the new play. Is that, I mean, I remember my wife and I a few months ago, we went to go see Boys to Men.
Yep.
In our local like town center performing arts theater. So they used to sell at MSG. Now they're playing Bergen County, New Jersey. But hey, I mean, but that was packed too. So look, I mean, I think that there's still. I think you'll find this interesting. I mean, remember that headline that came out not very long ago, maybe it was like in the last week, where the news media reported, well, people are spending more of their disposable income than ever on food.
Oh, and yes.
And then you peel back, you open up the hood and you say, well, actually, they're spending more on dining out than they are on grocery stores. So so in other words, it's one of these things like, to borrow from our former president, like the headline is real, but the news is fake, right? I mean, so the data are real, but the news is fake, right? So the implication is that people are kind of stretched, they're down on their luck and so forth. But in reality, it's the discretionary piece of the food basket that's actually rising more rapidly. So I still think that at the end of the day, what matters is our income's growing. Right. And so, people always ask, like, when is consumer spending going to slow down? When are these things going to normalize? When is goods going to come back to its pre-pandemic trend? I mean, the only thing that's going to make that all happen is job loss, frankly. I mean, so absent that, consumption will continue. And, I think people I think it's sort of the way it works is if you have a job, you'll figure out a way to meet your consumption demand, right? Like, am I going to save a little bit less? Am I going to shift my spending around a little more? But ultimately it's, I think it's all about real income growth, and real incomes. Just this morning, we learned real incomes, excluding transfers, are running about 3% over the last 12 months. The growth over the last 3 months has been somewhat stronger than that. So if that's what's happening, and that's a key determinant of recession, at least by the NBER, then look, it's highly likely that the consumption, that at a minimum, that puts a floor under consumption.
Right. Speaking of, like, going back to, you mentioned long and variable lags. I actually like a phrase you've used in the past. The lags between monetary policy and what happens to the economy are short and predictable. Right. And I think I've never heard anyone else say it that way, but that's really neat. And is that why everyone got that recession call wrong? Because the entire framework was based on long and variable lags, and that's why a lot of people are waiting for the next shoe to drop.
Well, I mean, it's like one of these things where there's some truth to it, but you're right there. There's some truth to long and variable lags in the sense that, okay, so companies need to refinance their debt. They're doing it at higher rates. That means that their cash flow is eroding. If you're someone on an adjustable rate mortgage and you're recycling into a higher rate, that's going to obviously mean that you have a higher monthly payment, which erodes your disposable income. So there's an element of it. But if you listen to the way people talk about it, right, it's like, well, it's 18 months or 12 months or 6 months, and I don't know exactly when, and but there's something out there. I mean, that to me is what I take issue with, right? I mean, because it's just not credible, right? I mean, it's like this sort of time dependency argument that makes really no sense. You have to look at the data and try to understand, how it's going to play out. So I think part of it is just people misunderstanding what the long and variable lags mean in the first place. It's not a time story, and I think also people just underestimated the amount of underlying momentum in the economy. If you have, first of all, we're coming out of a pandemic. There's a lot of pent up demand for lots of things. At the same time, obviously, we know the fiscal story was there. I mean, that's part of your job. You can't be like, oh, well, there would have been a recession had it not been for. Well, no, your job is to incorporate an aggressive fiscal response into your baseline outlook. And to the extent that people weren't doing that and they weren't accounting for all the mana that was coming out of DC, that's on you, But I also think for me, what was most important, and I think what I was sort of pointing out relative to others is that there was a huge shock when Russia invaded Ukraine, right? Like, so you had a big spike in food and energy prices, and you had the Fed really hawked up, right? I mean, they were going, we're not thinking about doing 75 at this time. Then they're doing them over and over and over again, right? I mean, they're leaking it out to the Wall Street Journal and all the rest of it. So that's the time to be very cautious. And that's when I myself was quite cautious in the middle of 2022 because of that. It's whenever you see a commodity shock taxing household incomes, at the same time the Fed is very hawked up, that is a recipe for bad news for the economy. But by the end of the year, that shock was fading, and the Fed was kind of taking baby steps to the exit, right? I mean, they weren't going 50 anymore. They were sort of doing 25s. Obviously, the food and energy story was, gas prices, as an example, ended the year about where they started. So, and the labor markets were still kind of hanging in there. So, in other words, the labor markets were not slowing as quickly as inflation was, and that drove up real incomes in the early part of 2023. And so that supported consumption. And I think that's why we didn't have a recession.
So this is live on Leap Day, Facts versus Feelings with Ryan and Sonu, being joined by Neil Dutta over at RenMac. We got about 30 minutes to go, Neil. One thing, this has been great so far. One thing I think is really cool that I've noticed you guys have been doing more of lately, it seems like, you've got a podcast now, a public podcast. You now have a weekly email that I believe is, it's free, right? I mean, people can sign up for this weekly email. You want to talk about some of those things if people, aren't paying you for it, but they can get some of it for free, a little taste to learn more about the amazing work that you and the team are doing. You want to talk about that?
Yeah, sure. Thanks, Ryan. Well, as you know, I've been on the sell side my entire career. Now, things are obviously changing. I mean, research is, as you know, much more democratized now than it was when I first started in the business, right? So there's been sort of, there's less gatekeeping, and that's good. It creates more competition. It also means that people have to ignore the bad players, and there are many of them, doomers and so forth.
Oh, yeah.
As you know.
Fight with them sometimes. Try not to.
But yeah, there's times to have those views and times not to. Yeah. Most of the time it's not, right? So, as you know, but... So, as a business, we're trying to figure out ways of reaching new audiences, right? I mean, that's what this is about. And so, RIAs, individual investors, obviously people that don't have the budget for, big institutional budgets to pay for research, that don't require as much, of a high touch kind of service. That's why we're doing this. But it's also just to get our views out there, because I think that's an important part of just developing our own brand, right? I mean, the more people know you, I mean, it's highly correlated, right? You will get more people to pay for you if more people know who you are, and if that means that you have to give away a few things for free, so be it. I mean, I think it is what it is. That to me is just a very small taste of what we do. We obviously have a wide range of analysts that cover different areas of the macro landscape. And what we put up on Twitter or LinkedIn, that's just a fraction of what our paying customers get.
Yeah, so I'm one of the few people who uses Google Podcasts. It's literally going away in a month. Call me old fashioned, but your podcast on here is just simply called RenMac. You can subscribe, and it's comes out usually on Friday. It's like 20 minutes, right? Steve does the policy, you do your lane, and then obviously Jeff does his lane. I love your podcast for 20 minutes, just kind of a review of what's going on out there, totally free. And then again, you can get your taste. And believe me, once you get a taste of RenMac, you guys are going to love it.
Same thing. I mean, I read all your stuff anyway that you can pay for, but I almost never try to miss the podcast. So every Friday. So no, that's great. Speaking of Twitter, you guys put, I don't know who controls who does your Twitter posts?
That's the question.
That's a good question. I mean, it's sort of a free for all. So Jeff and I are the ones that post on it. We don't have our own Twitter. We have our own LinkedIn's, but we don't do our own Twitter. We just have a company Twitter. And if Jeff has something interesting to say, he'll go out and say it. If I have something interesting to say, I'll go out and say it. Well, of course, we'll always repost like things that we've done on the media and for in articles on the journal or something like that, we'll repost that. But that's sort of like a repository of all the things happening at RenMac and all of our views, in terms of our in-house analysts.
Nice. I bring that up because I think it was last week you had a tweet out there saying productivity growth is hard to forecast. And if we are in a boom, something we'll see is upward revisions to consensus growth. You already mentioned that, right? Consensus growth to GDP.
Well, I mean, I don't know that that's a function of productivity. I mean, so one of the things you notice about consensus GDP forecasts is that surprises tend to be correlated over fairly long periods of time, right? So as an example, in the late 90s, really from 95 through 2000, you had essentially a 5-year period where the consensus was chronically underestimating growth, right? So folks started off the year at around 1.5%, 2%, let's say. And then by the end of the year, the estimates were up to 3%, 4%. That happened year after year. Now that typically happens in that happens when you have a productivity shock, positive productivity shock. By contrast, and then by the time the cycle matures, which was like in the 2000s, then the consensus is kind of getting on the right side of the 8 ball. And you don't really see many revisions. Similarly, in the 2010s, it was exactly the opposite that happened, right? I mean, if you recall, every year, consensus forecasters, equity market strategists, they had a very strong earnings and economic outlook to begin the year. And by the end of the year, those numbers came down, generally speaking. And that happened year after year. Now, that's the flip side of what happened in the 90s. We had a productivity boom in the 90s, and following the financial crisis, we had a bit of a productivity bust. Productivity growth was quite sluggish from 2010 to 2015. Now GDP growth has been going up. I mean, expectations, right? So this happened. I mean, last year, around this time, the consensus was expecting almost no growth in the first half of 2023. Obviously, we basically grew like 2.5%, 3% almost in 2023, fairly consistently if you look at private demand over the year. And it looks like it's happening again. Now, I don't know whether that's a function of productivity. I mean, mechanically it is, but right. I mean, the productivity that we're seeing, I think, it has. I mean, my experience is that if people are talking about something, then it's probably not yet in the data, right? I mean, that's kind of the solo paradox, right? It's so, we see all the productivity in the AI and ChatGPT, it's all around you, but it's not yet in the statistics, because it takes time for people to kind of make the knowledge investment to use the new technologies out there as efficiently as they can. So there's a bit of a learning curve involved. And so that's why, in my opinion, The AI story would probably just be gravy. I mean, maybe that has the potential to be like a game changer. And I mean, I think you can make a reasonable case that it may be. I think I heard one of your speakers before is making that exact case. Certainly, when I look at things like total factor productivity, right? Like that's kind of the economist catch-all for stuff that we can't explain, right? I mean, the innovation that's out there.
Sure.
That hasn't been, I mean, right? Like this is sort of the old Robert Gordon argument, right? I mean, back in the whole secular stagnation thing where it was like, the new stuff that we're coming up with now is not the same thing as like building out an electrical grid and the steam engine or whatever. I mean, so maybe the argument is like, well, maybe we're due for something. I mean, it's impossible to predict like what the game-changing technology is going to be. But I would say that most of the productivity growth that we're seeing, in my view, is primarily a function of like a normalization of the economy and the fading of the bullwhip dynamics that we've had in the economy, right? I mean, it's very difficult to have productivity in the labor market if everyone's quitting their jobs every few months, switching to a new one. I mean, you have to kind of keep your seat warm in order to get good at the job you're doing, right? Like, so the fact that quits are, normalizing is probably going to be good news for productivity because it means that people are attached to their jobs longer.
Yeah.
And the longer you stay in your role, the more efficient you get at it over time. And so that's helpful. That probably can continue for some time here. And so, and then the other thing I would say is that we probably have some kind of capital spending boom that's out there. I mean, if you look at business equipment spending over the last year, there was actually no growth in 2023 in business equipment spend, right? All the improvement in non-residential investment was from structures, which is sort of this, kind of weird CHIPS Act crowding in of some, factories and things like that. But there was not really much investment in sort of traditional equipment when we think of like CapEx. And so that probably changes this year. I mean, the biggest driver of investment spending is just an accelerator effect. So if people think growth is picking up, then they tend to, CEOs are more confident, recession risks have gone down. So of course, investment spending should go up. At the same time, it's really difficult to push the labor market any harder than it's been pushed, right? I mean, how much lower can you really get the unemployment rate? So in other words, capital spending is likely to outrun the growth in labor markets. And so if that's the case, you get capital deepening, which should in turn support labor productivity.
That was really interesting. I want to take this a different direction for a second. So obviously you work with Jeff, right? Jeff DeGraff, one of the greatest technicians to ever walk the face of the earth. And I want to talk about your career a little bit, because obviously you worked for Rosie for a while, I know, and I'm not sure where you bounced around, but eventually you made the decision to go from, maybe I'm going to call it, I hope this comes out, like a nice, cushy corporate job, to go work for, a small research shop that's just starting off. So you had to take that chance and believe in yourself, believe in what Jeff was doing. And obviously, I hope it sure feels like it's working wildly for you. We have a lot of individual advisors that listen to this, small business owners. How did you know it was time in your career to take that chance from leaving a solid job for taking a chance on betting on yourself?
Well, there's a couple things. I mean, obviously, I did work at Merrill Lynch for, I think, 8 years.
Okay.
And I worked under David Rosenberg, and also Ethan Harris, who recently retired.
Okay.
So that was kind of a good background because, Rosie, he's sort of a great, he's like a marketing machine. Like if you want to think like, what is a Wall Street economist supposed to do? Him. That's what you're on the phone. You're at, like, find me at the nearest tarmac. I mean, kind of like you're meeting with accounts, clients, you're publishing all the time. I mean, it's just the sheer volume of things that he would do for his clients, for the clients of Merrill was just enormous. And, that kind of gave me an early sense for what a Wall Street economist should do. And, now obviously one of the things that happen at a bank is that the macro people aren't going to be on the morning call every day, right? I mean, you're not going to have the salespeople pitch the macro stuff every day. They want to be on the phone with their accounts about company XYZ. Maybe, you're not going to, right? I mean, maybe it's corporate credit guys aren't going to want to talk about macro all the time. So you're kind of competing with a lot of people for space, right? I mean, for space on the front page. And at a smaller shop, I don't have that problem. RenMac, all we do is macro. We want to be the go-to source for how you incorporate macro thinking into your investment process. And I don't have to compete with anyone to get time on our morning call. We have a morning call with our sales team every day, and we have salespeople, all over the country, in Europe, right? And so I don't need to, worry about, am I going to get to talk to my sales team today? I will. And that's a big part of how we kind of distribute our views, is having a good sort of macro specialized sales force behind us. And, again, that's not something that a lot of the big institutional firms have, right? They have specialty salespeople for discretionary and industrials, but they don't have specialized macro salespeople. And so in some respects, macro can sometimes become an afterthought in a lot of the big shops. So that's kind of why I took the leap. I think it's, do you want to do a lot of things not well, or do one thing very well? And I think, for me, that was the trade that I made by going to a smaller shop.
Seems like it's working out nicely.
Let me jump in just for a second. That was awesome. Just hold that thought for a second, Sonu. So we didn't give another plug for St. Jude. Feel free, Chelsea and or Sam, and put that up there. I think it's there it is, events.stjude.org/leap day, up to $850, which is awesome. This obviously is free, right? We're doing this all day, but if you want to say thank you for a lot of the work that we're putting on, we'd love if you could give a donation there, because St. Jude's an amazing place that helps so many children with cancer. And what it does, you never pay $1. If you go to St. Jude and you stay for a month or two, which is obviously what happens in a lot of cases, people don't have to pay. So it's what all that charity goes to. So if you've enjoyed it all, what we've done to this Leap Day, anything you can give, we'd really, really appreciate it. Up to $850. Let's keep it going. So thank you. Go ahead there, Sonu.
Yeah, no, actually, just pulling on that thread, entrepreneurship and going to small firms, business applications right now, Neil, are running pretty hot. And what do you make of that? Is it just something just changed after the pandemic? People started opening new businesses, things like that. It seems like it's very different from what was happening between, say, 2010 to 2019.
Well, I mean, that goes back to the productivity conversation, right? Because a big reason why people thought productivity was so weak in the 2010s is that we didn't have much new business formation, right? So you had, and obviously new businesses are an important driver of productivity, because that's how a lot of innovation happens, right? And so, to the extent that we have more business applications, more entrepreneurialism, maybe, that's probably a good thing. I don't know why it happened. I mean, I think, is it a function of people kind of, more willing to take a chance after the pandemic, right now wanting to go back to the kind of corporate grind? I mean, maybe there's some of that. It could be a lot of things. I mean, maybe people have kind of paid off all the equity on their homes, and now they want to go try something else, right? So they don't need the security of a cushier job, so they want to go out and try new things. I mean, there's a whole potential range of explanations for why that it could be, but generally speaking, it's probably good to have more businesses being formed than not. I mean, you want to have more businesses formed. You want to have business failures. I mean, you want to have all these things. That's what makes a dynamic economy.
That's great. I mean, I want to. We've got about 15 minutes to go here, Neil. So again, thank you so much for taking time with us. You're amazing, the stuff you do. I want to talk about Jeff for a minute here. I know I know he's not here, but what are a couple things Jeff's been seeing from the technical point of view that maybe is worthwhile to point out? And one more thing, what I'm such a fan of the way you guys do your work, because honest to goodness, at our shop, Carson Research, right? We have house views. Maybe I'm like, I'm not so crazy about that, but it's the house views and it's how it goes. What's so cool about you guys is if Jeff sees it one way and you see it another, you just share it. It's like, okay, make your own decision. This is how we see it. I think that's really, really cool the way you guys are able to do that. But what are some things Jeff's seen out there from the technical point of view you want to share?
Well, I think Jeff is pointing out to a broadening out of market conditions. I mean, for example, I'll always talk to him about like a lot of that cyclical stuff. So, they just put a note out recently about the broadening out of improvement in the retail space. So when you look at things like home improvement retailers, I mean, they're going straight up and to the right. So how worried should we be about renovation spending? How worried should we be about construction activity? Obviously, we look at things like industrials. Industrials have been doing reasonably well. Rails. I mean, I think that's another sector that Jeff has been pointing out that looks technically very attractive, which again, I mean, this is one of these areas where we've kind of been in agreement, right? I mean, it's always difficult for our sales force when we're not in agreement.
Sure.
It's less difficult for us because we'll just keep saying whatever we want to say. But, for our sales force to kind of massage the message, I think is a little bit more challenging. But, the rail one is an interesting one because that to me is a sign that the inventory story is clicking, right? I mean, if you have rails doing well in the markets, rail car loadings are up, then that's obviously going to be a sign that inventory restocking is happening. And obviously you need to move the inventory around the country. So I think that's kind of an area where the economics, kind of line up with the technicals.
That's potentially a tailwind for GDP growth then this year.
Yeah, sure. I mean, inventories are going to be a tailwind for GDP. I'm quite confident that will be the case. I mean, they haven't been a tailwind for the last year, even though consumers have been spending money. I think the other thing I would say is that Jeff is probably somewhat more bullish on bonds. Okay. I think he does. I think he, generally speaking, does view the recent upturn in yields as kind of counter trend, as you would say. So I think, and I would tend to agree with that because I think people have kind of lost sight of the fact that inflation is unlikely. It's still on a downward trajectory. So I wrote a piece earlier this week where I basically told our folks that I thought it was wise to kind of take long positions in the front end of the yield curve because I'm skeptical that the odds of cuts are as low as people saying they are, at least in the short run.
Right. So on that, how many rate cuts do you think the Fed will do this year, and when do you think they'll move first?
So I've been telling our clients May. I mean, as you know, I was in March. I mean, but that obviously isn't happening. I think one reason why that didn't happen, frankly, is because they were so surprised at how quickly inflation was slowing that they didn't actually set the table to communicate the March cut. And now, we kind of hit a buzzsaw with this January print. So, but you could see renewed kind of downward surprises on core inflation in the March to June period, and I think. That still makes it highly likely that they'll be cutting before June. And so, I think if I looked at it recently, I think May was like priced 10-15%, right? I wouldn't be surprised to see that going higher between now and then. So, we'll see. In terms of how many times they go, I think they'll go 3 times. That's what they're telling us, but that's not the reason why I think it. I think it's just a recalibration of policy. I mean, the Fed can't. First of all, if they're starting in May or June, there's no way you're going to go that many times. They've also now started to communicate that they want to go more haphazardly, not necessarily linearly, right? So that kind of raises the risk that they're not going in consecutive meetings. That maybe they'll go once, see how the data shakes out, go again. If you were thinking maybe they go May, June, July, maybe now they go May, July, September, November. Right? Maybe the cuts are more spaced out. But ultimately, I think they'll go three times. If inflation slows a little bit more than they see, then maybe 4. I don't think it's going to be any more than that.
So what worries you right now? What could the economy looks good, consumer strong. What could upset the apple cart, you think?
Well, it's interesting you asked that, Ryan, because I think the things that what worries me is when people don't position for the upside risk scenario. That for me is the bigger, right? So whenever, right? I think we've been conditioned over the last 14, 15 years after the financial crisis to always look for what is the downside risk? What is it? A government shutdown? Is it a debt default? Is it China blowing
crisis in China?
Is it China blowing up? Is it some geopolitical is my favorite because that's something that people always say when they have nothing left to say. It's there's going to be something that happens in the Mideast and the oil prices are going to spike. It's sort of, I don't know. But I think the risk is that what if productivity continues to surprise to the upside, and unit labor costs continue to surprise to the low side, and I don't know. We just have a higher structural run rate for the economy. I mean, that would probably resolve a lot of issues for people. And I think that would be right? Because right now what's happening is, stocks have had a big run, and it's the same argument. So stocks have gone up a lot, right. Therefore it's time to be cautious. I mean, well, when everyone's saying that, maybe it's more prudent to think about what the upside risk could be and why stocks would continue to grind up.
So I love that. Last June, I was on with Judge on CNBC, and he asked me that. Like, well, I was bullish. Well, you're so bullish. What's your biggest worry? And I actually spun it back to what you said. So what if all this stuff keeps happening and we're in a bull market? People are not positioned for it. So I think we're kind of seeing eye to eye. And I will say one more thing, and then Sonu jump in. You mentioned geopolitical concerns. Have either of you had a chance to watch Shogun yet on FX/Hulu? Have you seen Shogun yet?
It's on my list. It's on my list.
Awesome. They said 2 episodes so far.
That's on my list too, by the way.
It is a really it's got 100% Rotten Tomato, which I mean usually I don't like. That means I'm probably not gonna like it. I like the 10% action movie Rotten Tomato. Let's be very clear. But Shogun, I don't know if any listeners are out there listening. Shogun's really awesome. I guess there's only 10 episodes, and they did the first 2, and now it's weekly. But I think you guys will like it. There's some geopolitical concerns and risk in Shogun. We'll leave it at that. Yeah.
I'll have to downgrade, Beekeeper from my list and push Shogun.
Beekeeper's really good though. Beekeeper's up there. Yeah.
I almost saw it last weekend, but I then switched. I saw Ferrari, and I'm a sucker for anything related to motorsports. So
I've actually been watching Love Is Blind.
Oh,
nice.
Is it good? Is it good?
Is that a couple thing with doing?
Requires no thinking whatsoever.
Mm-hmm. Yeah,
that's funny. But going back, how much time do we have?
7 minutes. We are at the 7-minute warning, if that's such a thing. Yeah.
No, I like what we were talking about just now because with markets and it's not just about figuring out what's the economy going to do, what's profits going to do. Is like what are investors pricing it, right? Mm-hmm. And right now it seems like I think we are on the same page, seeing eye to eye, quote unquote, that what's not being priced in may be an upside surprise, right? So where are you with respect to going back to productivity and the AI story, right? Obviously, if you listen to Dan Ives and Kathy Wood, who was on the live stream a couple of hours ago, I think both of them probably have different measures for it, but they think AI is going to drive that story a lot more, right? The productivity story. So just going back to where are you on the AI story there, but also as related to investing? I know going back to what Jeff does in tech and communication services in particular.
Well, I don't have a good view on the AI story. I mean, that's sort of outside of my my expertise. I mean, I think that like anything, I mean, it's still all I will say is that it's still very new, right? Like, so the people that are using it in day-to-day applications in their jobs, they're probably still in the learning process of using it. Right. I mean, there's probably more efficient ways of applying AI to your day-to-day service office jobs than we're currently doing right now as a economy. And so to me, that means whatever productivity you're seeing right now has very little to do with what's happening with AI. It probably has a lot more to do with just a normalization after the pandemic. Now, I also think it's likely that companies will probably be ramping up their spending on AI because they have to, because part of it is if you can't push labor anymore, if you can't get more labor, you're going to have to find ways to supplement that to meet your demand needs. And that means that AI investment will probably be going up in the coming years. And it's like anything, right? I mean, if you're making a big investment up front, there's a risk because you don't know if that's going to have a payoff or not. But what it does demonstrate is that companies are relatively optimistic about the future if they're willing to make those investments. You wouldn't be doing that if you thought there wasn't going to be a payoff. So, but I do think it's probably too soon to pin the recent upturn in productivity on AI.
No, that makes sense.
Got it. Well, Neil, we have a couple minutes left. This might be the final one. I've asked this to all of our guests today. Might have asked it to you last time you were on, honestly, but I think it's a good question. If there's some 20-year-old kid sitting out there watching this who wants to be the next Neil Dutta, what career advice would you give someone younger that you didn't know at the time, but obviously you've learned over time? What's some some nuggets of wisdom from Mr. Neil Dutta.
Well, I have a bit of a chip on my shoulder. I would say that to get into business economics, you don't need a PhD. That's important. I mean, no offense, Sonu. I mean, you don't have a PhD in economics, but
he's an engineer.
I'm an engineer. And I'm no longer an engineer, so take the PhD for what it's worth.
But I do kind of clam up a little bit when people call me an economist, or because I don't consider myself one. Yeah. I mean, I think I'm more of we call it business economics, but it's applied, right? I mean, you're essentially like a market economist. It's not the same thing as an academic economist. But I think what's important for people to understand, particularly young people, is that find something that you think no one else is kind of talking about and defend it, right? I mean, and sort of research it, defend it, and make your case, right? That to me is kind of how you stand out. And that's a big part of what we do, right? I mean, to me, at its core, like sell side research, it's a debating business, right? I mean, that's what it really is. I mean, you have different research providers. They're all making their pitch. They're making their case. And what's important is not necessarily to have the loudest megaphone or, being contrarian for the sake of being contrarian, but doing your research and then picking your battles wisely with the consensus, right? I mean, people that are always kind of lighting their hair on fire to say the opposite of what everyone else is saying, those aren't the people that you're going to be wanting to listen to, because in my experience, a lot of those times they're like wrong, and then spectacularly right. What you want to do is in my view, is try to be the person that's right about a lot of small things and be right about one big thing, because that's not how you can really make money in this business. So, my advice would be to pick your battles. Like if there's something that you think that the consensus isn't seeing, and do your research and then come up with a cogent, logical argument for why that is. But what I would highly recommend against is just kind of always taking the other side of whatever the consensus is at the time, because that's not really a way to be useful in this business.
No, that was great. Also, I just saw we just cracked $1,500 worth of donations. So let's put that up one more time, Chelsea, if we could. But Neil, this was awesome. How about one more time? Where can the listeners find? You'll follow you guys a little bit easier. The website, the Twitter, whatever. Just promote yourself a little bit more, because your research is truly second to none.
Appreciate
and
that.
donate to that thing again if you want. Feel free. Give twice if you want.
I appreciate that. So you can find us on Twitter at RenMac LLC. And if you're interested in our research, you can go to RenMacAccess.com.
Thank you, Neil. Look forward to reading your stuff. Take care, man.
Take care.
Appreciate it. Well, that was awesome. I mean, there's a reason I think we are such fans of RenMac and Neil. I mean, Sonu, what'd you think? That was great. He's just so good.
I learned that I should go on a Disney cruise.
Yeah, that's true. I learned how tired on the YouTube channel. You and I were a little tired by then. Neil was again. Yeah. This as we discussed there.
Hopefully it's not too obvious, but
yeah, that was the fourth one. So for 4 hours, you and I were talking about markets and doing things, and Neil was our fourth guest. So thanks to Neil for bringing some energy, because you and I originally, I think our team kicked around doing it for 3 hours, and you and I were like, we'll just do 4. But looking back, I think 3 would have been the ideal number. That last hour.
Of the plans we sent out, one of the emails I sent out had like 6 guests or something.
Well, you and I, you and I think big. Sometimes we need people to rein us in. But that was, again, that was with Neil. Excellent discussion. Thank you so much to Neil and RenMac for joining us on Leap Day. And speaking of Leap Day, if you enjoyed that conversation, this link is still live. We took some donations for St. Jude. St. Jude is the hospital. Obviously, it helps so many children with battling cancer, but it helps the families, because unfortunately, a lot of these families have to stay for a very long time to be with their children. So if you donate to St. Jude, families never have to pay anything. So we still have this live. It's events.stjude, stjude.org/Leap Day. Events.stjude.org/Leap Day. If you enjoyed Leap Day, if you enjoyed the conversation with Neil, we still would love, or we still appreciate some donations there. Now, Sonu, last thing we want to talk about. Where are you right now in theory? We recorded this before you left the country. Where are you right now in theory?
I'm in India. I think I'm in Bangalore.
Okay. Who knows where you are?
Yeah. Like, I hope I'm here. I'm here in India. But no, I think it's speaking of travel and Disney cruises. India is not quite as, not quite a Disney cruise, but it's still fun. I may be in the middle of traffic as this episode goes live. Who knows?
A little bit of that over there, I heard. Yeah.
No, it's been fun. I'm here for my sister had a baby 4 months ago. I'm here to see the little baby, and it's been so cool. It's been fun being with her, the family, all my friends, a whole bunch of them. My family, wife and kids back in Chicago, enjoying spring break. Hopefully they're enjoying spring break. So I'll get back in a few days.
So you and I are foodies. What when you get back home, is there like a favorite restaurant, a favorite? I mean, I guess to me it's called Indian food, right? But I mean, there's probably more specific foods in India. The American, Indian food. What do you like to eat? And is there a favorite place you go when you get back home?
Ooh, I like my home, like my mom's cooking and all of that. So it's home food more than that's one thing. I mean, if you ask me what my least favorite food is to go out and eat, which is strange coming from me, but maybe it'll make sense. It's Indian food. I don't like going out for Indian food because
can you say that?
This doesn't cut it, right? I mean, there are a few restaurants in Chicago that I like, but even here. But it's mostly about we go out, have a drink or whatever. It's if you want real good Indian food, I'm like I'm having it at home more than outside. Outside, you get together with friends, and for the most part, they may be eating chicken wings or something. Maybe with Indian spices more as opposed to buffalo sauce. But no, I don't have a favorite. Anything with coconut milk. I like that. That's a part of India. I come from South India. If you've had Thai food, I mean, you see a lot of coconut milk.
Sure.
That's very similar to the stuff I like too. And in the region I come from, which is Southwest India, Kerala, you get a lot of that.
Okay, yeah, I like pad thai. Is pad thai a big one then? Is that
not quite pad thai, but the coconut part.
I figure not.
Okay. Is someday I'll just cook for you. I wouldn't know what restaurant to take you out to in Chicago. Indian restaurant. I mean.
Well, I'm willing to try. I've never been a huge fan. No offense here, huge fan of Indian food. Never really been open to it. I guess maybe I need to go to India and eat moms. I need to eat moms Indian food. That's the way we got to do it.
I'll just cook for you.
There we go. I like it. So with all of that, though, hopefully you really enjoy. Or I know we did. Hopefully you enjoyed that conversation with Neil Dutta of RenMac on the economy that continues to surprise the upside. Again, this was episode 78. Of Carson's Facts versus Feelings with Ryan and Sonu. We'll be back next week with a regular episode, and we're inching closer to our final Leap Day discussion we had, which will be Dan Ives coming up in a couple of weeks. But with all that, thank you to Neil, and again, the RenMac. We'll see everybody very soon. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.